Mike J says, pros and cons of poor man's covered call, i.e. diagonal. Fantastic. I'm going to mention two things here, though, first. Going back to the YouTube channel here, let's go to playlists. And Mike, one thing that I was working on and I didn't do it, I have it written out here, which ones I have to put together. I didn't get to it this week, are a playlist for bull call debit spreads. Yours will be included in that too, and I'll get that up sometime next week. For Michael J, and your question related to the poor man's covered call, there's a playlist here, a calendar call, diagonal poor man's covered call. If I click on this, it's going to start playing, and that's not what I want to do. I want to view full playlist. There we go. Thoughts on calendar spread, good candidates, guidelines, review, importance of debit to strike difference. We're going to talk about that, management techniques, and more. But I just wanted to show you where that was. Go to YouTube, find the Power Options channel, check out that playlist for some others there. Calendar call spread, poor man's covered call, diagonal spread. Remove covered call here. It's under calendar call on Power Options. Let's save that configuration. All right, so what are the pros and cons of a poor man's covered call, i.e. diagonal? Big pro, it allows you to trade stocks in a bullish nature that you normally would not be able to trade due to account size limitations. I trade calendar calls, poor man's covered call. I'm going to tell you why I don't like that term in a moment, Michael, I should say, excuse me. But pro is you can use higher price stocks because we're just buying a call option. I might trade this with Amazon from time to time, Tesla if I feel comfortable with it, which is hard to do sometimes to feel comfortable with that stock. But you can do higher price stocks that you can't normally afford to do, a married put, a covered call, cash secured naked put, buying a call and selling a call against it just like we owned the stock. It's leveraged, so we have to put out more money, which also means higher percentage return. Just like essentially what a calendar spread, diagonal spread, poor man's covered call is essentially just a bull call debit spread that we talked about before. We're just buying a call much further out in time so we can have more right cycles against the position. It's a leveraged trade, which means a higher leveraged return. Cons of the position. Number one con is, well, with leverage comes the lie of leverage. You can lose high percentage amounts of what you invested into the position. I'm not in the stock. I'm in a call that gives me the right to buy shares of stock that might be 6 to 8 to 10 months out in time, depending on what structure you're using, Michael. However, if the stock falls 10%, my value of that call option that I bought, even though it's slightly in the money, might be down as high as 25, 30, or 40% of what I invest in the position. I see a 15% decline. We might be 45 or 50% down on what we invested into the position. Can you keep writing against it? Sure. But if the stock has fallen now below your long haul strike price and you're trying to make that up by selling calls below it, you're actually doing a bearish trade now for management. That can come back to haunt you if the stock recovers. So cons, you have high loss. Improper structure can give you two ways to lose. You can lose to the upside and to the downside. So you can actually have two ways to lose, and we're going to cover that in a moment. So these are the basic pros and cons, Michael, of the calendar spread. Gives us a great way to trade stocks with the potential for high leverage returns. We can have multiple right cycles to sell against it, maybe even pay for the cost of that long call over time, depending on how far out you are. Cons, of course, leverage works both ways. The lies of leverage. You can't afford to take a 70, 80, or 90% loss on one of these positions. You're going to have to manage it to keep it from losing more than 40 or 50%, just like we would look to approach and say a bull put credit spread or other structures in those cases. Let's take a look at the default calendar call search because I want to show you some examples of what I mean by the improper structure and the risks. Our basic default search, we're looking at, that's not a great stock, it's a low price stock. US Bancorp's pretty good. I think this one's a little bit far out of the money for me, but we'll take a look at it on the Coca-Cola one. But again, we can look for high price stocks here. Let's take this down. Let's just look to standard April expiration. Yeah, 250. Let's just go 250 to 400 days. We don't need the double leap status there. looking for a minimum 4% return. That's just on the first right cycle. But what I want to do here is I want to restrict this to be no more than 3% out of the money on the call. Important factors. I do want to be in the money with my long option. So we're starting off looking for a long option delta of at least 0.6, but I still want a good delta ratio. With the calendar spread poor man's covered call, you're going to start looking at new aspects, new terms you might not have used before in other strategies, delta ratio, implied volatility ratio, and so forth. You may even want to pay attention to the volatility skew on the two options also. What do I mean by that? In general, I don't want to buy an option that's further out in time that has a higher implied volatility than the nearer term option that I'm selling. Yeah, it's far out in time. It's going to decay more slowly. But again, when doing a calendar spread, most calendar spread poor man's covered call investors are going to look for implied volatility ratio of greater than 1. The sold option implied volatility is higher than the buy option. And we're going to look for a delta ratio of greater than 1.8 or greater than 2. What does this mean? This is the delta of the long option divided by the delta of the short. Why do I want this so high? It's because the stock starts to move up as I'm expecting, because it's a neutral to bullish strategy. I want my long option to gain more than the short option. But we'll talk about the delta ratio reverse, which happens with any calendar spread if it's in the money as we get closer to expiration in just a moment. And what I really like to have is a debit to strike difference ratio of less than 1. Michael, what this means is that I always want the net debit that I'm paying into my diagonal calendar spread, even on the first right cycle. I want that debit to be less than the difference in strike prices, so I don't have two ways to lose. In my opinion, that is the proper structure, and that is what we advocate here at Power Options. Oh, I made some changes. I adjusted some things. So, I gotta take this out. I'm sorry. That was all I changed. I just don't think it didn't like, there it goes. Okay, so it took down a lot, and that other U.S. Bancorp position comes in, but that's fine. I'm going to stick with it. Ex-dividend date's coming up, but that's okay. I'm not worried about that. All right, so with U.S. Bancorp at 57.12, we can sell the April 59 call standard expiration for 48 cents. I'm sorry, I just noticed that. I didn't have the earnings date not between now and expiration, but we'll talk about that in a moment. And we're going to buy a slightly in the money January 47.5 far out in time leap call for 11.3%. Rough assignment is 17.1%. We're not getting much downside protection. I usually like this to be higher. This is not like a covered call downside protection. What this is saying is that we're technically collecting 4% against the cost of the leap. Well, it's $11 for the leap. If I wanted a lower debit, I'd move this closer in. I'd only be looking at positions that are 80, 90, 120 days out in time. But we're just going to use this leap example. Let's just go to the profit and loss chart. Okay, so here you go. And you've seen these profit and loss charts before. I don't need to go up to 90, do I? No, let's just go up to about 70. There we go. Now, we do have the chance for a 28.1% maximum return. But one thing we have to be aware of for those of you that are new to the calendar call concept and using the term poor man's covered call, if I bought U.S. Bancorp right now at 57 and sold the 59 call for 48 cents, I'd have a profit of about 4.5% if the stock was trading anywhere above $59 and I was assigned. On a calendar spread, the return that you see, whether it's on the graph at your broker, if your broker has a screen, on the Power Options screen, this is the max return that occurs if and only if the stock is trading right at our short call strike price at the short call expiration date. On April 14th, if the stock was trading right at 59, this is the max theoretical return. Unlike a covered call, it's not guaranteed that you're going to make this return of 28.1%, even if the stock is trading right at 59. Why? Because the only way that we can calculate this, and by we, I mean your broker, I mean here at Power Options, I mean any other options data provider, this return is based on the theoretical value of the long call at short-term expiration of April 14th if the stock's trading right at $59. Why is that not etched in stone? Because in calendar spreads, you've got to be very careful. Oh, that is bad, isn't it? With implied volatility, this can change. If the implied volatility of our leap option drops in the next 20 days and goes down to, say, 0.28 or 0.35, this is going to have a lower expected value in the Black-Scholes pricing model. It would have a lower actual return. Now, your plan wasn't just to get this on the first cycle. Likely, if I'm buying, especially if I'm buying this leap option, I'm planning on writing this several times against it to continue to knock down this price because I'm neutral to bullish on this position for an extended period of time. But again, that's one of the aspects. Why does the profit and loss trail off here anyway? What is happening here? Why is this trailing off on this position as the stock is moving up? Why is this not like a covered call where my return is always 4% or my return is always 28% if the stock is trading anywhere above $59? And that's because at expiration, short-term expiration, we have a flip of our delta ratio. And what do I mean by that? We started with an in-the-money call out to January 2023. We're at the 47.5 strike, which has a pretty high delta of probably, let's say, 0.7. Let's just guess. We could look it up. It was probably on the other screen, but let's just say 0.7. And my 59 call that's out of the money for April 14th probably only has a delta of around 0.3. Now we get to expiration. We get to April 14th expiration. U.S. Bancorp has moved up to $62 per share. Or it's April 13th. Or it's April 12th. What's happening here? This short-term option is now in the money, and it only has 1 to 2 days to go to expiration. This option is going quickly to a delta of 1. And even though this option is deeper in the money, it's still out a whole leap time frame out to January 2023. This is probably only a delta now of maybe 0.82 or 0.85. We have a delta flip. Our delta ratio is now below 1 because our in the money option that's getting closer to expiration has a higher delta. Now, for every dollar the stock moves up, it's costing us more to buy to close this option to roll it than we're seeing in the gain in the leap option. It's not gamma. It's just the effect. It is gamma in a sense, Michael. But when you get to expiration, what do you know about any in the money call as you get closer to expiration? It's going to a delta of 1. That's just happening. You're absolutely right. Yes, the gamma is affecting the delta. You're absolutely right. But as we get closer to expiration, that's just both getting closer. This is just getting closer to 1. Gamma is actually getting closer to 0 because you can't get any more than 1. Whereas this is not going to go to a delta of 1, even though it's deeper in the money. It's not going to go to a delta of 1. So that's why the profit trails off as you go deeper in the money in these scenarios. That's something to watch out for. Now, let me go back to the search very quickly. It's not a con. It's a caveat that you have to watch out for. It's not a con of the strategy. It's just something that exists in the strategy that you have to watch out for. I want to take this debit to strike difference ratio out. And what did we add? We add some other U.S. Bancorps in there. We've got the 5950. That's so close, but it's not quite there. What is this one? 1069. Okay, that's not it. Where was the other U.S. Bancorp that got added in here? It's the 5952.5, 750. No, it's not. I'm sorry, it's 650. Perfect. That's the one I want. This one here came into the equation because I removed the debit to difference to strike ratio. And let's go to the profit and loss chart now. Okay, it's way out of bounds. The stock's not going to go to 78.50, okay? But what are we seeing here with this position? What we're seeing here is a position where the net debit of 721 is less than our difference in strike prices of 650. So now we have 2 ways to lose. Why is this a concern? Because if the stock suddenly did spike up in this scenario and moved in the direction that we wanted to see, even if it moved to 65, not even up here where you're seeing a loss, but if it moves up to 65 and you get assigned early on your 59 strike, what is your broker going to do? Your broker is likely to exercise the long to deliver the short, even if the stock was at 60. Someone who came from covered calls trading and just jumped into diagonal calendar spreads or poor man's covered call and thinks, oh, I have a 36.4% return. I'm going to experience that if it's anywhere above 60, just like I would with the covered call. No. In this scenario with the improper structure, our net debit of, let's just call it 720, is higher than the 650 difference in strike prices. If I'm in the money and I let this go in the money and I get assigned earlier, I just hold it to expiration thinking I'm going to make 36.4%. No. My broker exercises the long, buys shares of stock from me at 52.5 to deliver at the obligation at $59. I only get $6.50 back. We are at a loss of 70 cents on the position. We're not here. That's the other caveat of analyzing a profit and loss chart. These profits here are only based on if you're able to buy to close the short call and sell to close the long and take advantage of the remaining time value that still exists in that leap option. This is not the return at assignment. When you have the debit to strike difference ratio incorrect, you give yourself two ways to lose. And in fact, at assignment, this whole position would be at a loss of 70 cents. If I get assigned anywhere at this point and allow my broker to exercise the long to deliver the short, I'm at a loss of 70 cents because I'm only getting $6.50 back. These returns are based on being able to liquidate your long call or leap option and buying to close the short, not taking assignment. That's one of the reasons why I don't like to use the term poor man's covered call, because it's not like a covered call where I can assume that if the stock's anywhere above 59 at expiration, I'm going to make 36.4%. No. That's solely based on being able to liquidate, and that's solely based on the theoretical price of this position at short option expiration, which can be lowered if implied volatility of that option again decreases. This is the 52.5. We were looking at the 47.5 before at 0.33. The 52.5 is only at 0.3018. Now, on this position, I wanted to show you something else as well. We have a net debit in this position. It's the improper structure, I know, but we have the net debit here of 721, Michael, for this trade. The value of our leap option was 773. We didn't get much, 51 cents only, but we paid 773 for this position. Now, remember what I talked about the lie of leverage. We see the possibility of a max 36.4% return if we could liquidate it. The stock's trading right at that price. If we could liquidate it, we still see potential here. But again, with a debit greater than the difference in strike prices, this would be a loss if I allowed assignment. But the lie of leverage works both ways. Close to 10 points down. And let's just go to April 14th expiration. What's going to happen? We're going to get the full 51 cents here. But our long option now is only worth 544. It's dropped 200 points in value. We've got a loss of 177.50 right now in this position. And based on your initial net debit, if you liquidated, you're not out of the position yet. But where is the call at 52.12? The call is now right at your short call strike price. And you've got a loss of 177.50 if liquidated. And your debit was 721. So that's a loss of 25%. Stock only fell 10%. You're losing 25. You look at it another way, say that what you paid into, you paid 772 into this leap, not including the 51 cent credit you received, but now it's only worth 544. We've lost 230 roughly on an investment of 772. That's down 30%. Okay, that's the lie of leverage. That's what we're talking. This is a 30%. This value here is 30% from what we paid for it. Now we hedged that with this call, true. So we're only down about 25%. But again, that's with the stock falling 10%. If the stock falls 15% naturally, if it went right to 50, that's close to 15. It's not quite 15. Not quite half, but yeah, we're at a pretty significant loss here on our leap option. Remember, the leap is now your investment. We're not invested in the stock in this position. But $340 close to loss on an investment of 772, that's 44%. Yeah, your true loss here with the credit you received is only 288 or so, but that still works out to be pretty high. That's a 15% decrease or close to it. And we're talking about a 36% loss on the position with 15%. So that's what you got to keep in mind. The lie of leverage works both ways. How far is too far before you're looking at a 50, 60% drop? Oh, and by the way, now that the stock is 50, I'm not able to sell the 59 call anymore. That's worth 5 cents. I'm selling right at my strike, 52.50, and I probably have that structure, Michael, where I have two ways to lose. So I just wanted to illustrate that while we were here on the profit and loss chart in the other aspects. I'm not trying to scare you away at all. I use this strategy. I like this strategy, but I want you to be aware of the caveats. It's a good way to continue a trade that you're bullish on for an extended period, especially one you might not be able to forward in your account, that I wouldn't do as a married put or as a covered call, as a cash secured naked put. I'm going to do that one if I like it as a diagonal spread. I can still play the big stocks, playing it as a diagonal spread. I miss out on the dividend, so it's not something I'd really do on a dividend. I know we took U.S. Bank Corp, but I want you to pay attention be aware, I should say, of those aspects. You want to look for a good delta ratio. You want the debit to strike difference ratio to be less than 1. As we discussed with the profit and loss chart, the improper structure can cause you to lose twice. You always want that debit to be less than the difference in strike prices. And of course, remember, this is not like this is not like a covered call, where when I see a calculated return on this position, it doesn't mean that if the stock's anywhere above my short call strike price, I make the 49%. We're going to see a trail off of that due to that reverse delta flip. And this return, remember, is not an assignment return. It's the max return if the stock is trading right at the short call strike price at expiration and you're able to liquidate the long call if the theoretical price at this time and the implied volatilities kind of remain the same. Okay? In that case. Well, Michael, there's no such thing as an optimum owned option, in my opinion. Okay? What I mean by that is that depends still on the underlying. That depends on shifts in implied volatility, which will happen, and it's going to dictate price changes, as we were just sort of reviewed here. So this follow-up question is, what is the optimum owned option in length? That also depends on your targets and your goals. I prefer to the diagonal spreads that I use in my personal account to follow the same rules that I use for the married put structure of radioactive trading, following the 3 core principles. And what I mean by that is the 3 core principles are sort of, the at the money bell curve. I don't want to be buying at the money. We're already buying in the money because I want that good, strong delta. And I'm buying an in the money put for the married put approach as well, Michael, to give me the best risk control on the stocks that I own. But now we talk about the big one is the time decay curve, where if I'm 200 days out here, maybe 150 here, 120 here, this is 90. This is a little skewed. It's more than this. And then this is 60. And then here we're at 30. And here we're at 10, let's say. Okay. What is this showing? This is showing that you expect when you're far out in time, in those first few right cycles, the time decay is much slower if you're at 180, 200, 250 days out in time. Once you start getting close to 90 days, you start to see the more rapid time decay on your option. Following this rule that works for us with the married put approach, I do the same with my diagonal spreads, which is why you sort of saw that on the initial default screen, 250 to 650 days out in time. I like to go at least 200 days out in time, 180 to 200 days out in time minimum. I might use leap options so that in those first few right cycles against the position, the first month, second month, or third month, I'm seeing a much slower time decay on that long option, and I'm able to still collect good premium against it. That's if I'm bullish longer term, and I'm looking to do a longer term trade. I have many investors on PowerOptions. I think this is a sample search I have. Maybe not. Nope, it's not there. Okay, so I don't know if I put it in the search. I apologize. Let's go back. Oh, I thought I had one in here. I'm sorry. Anyway, I have some investors who use PowerOptions and will use a similar structure, but they're only going 60 to 75 days at a time. Let's go 75. So somewhere between 45 and 75 days out in time, because they're looking to sell weeklies against it. They want a good number of right cycles. They want the same approach. Don't use Micron. Don't use Micron. Micron has extremely high implied volatility because, I'm sorry, I changed that wrong. There we go. Not between now and expiration. My apologies. There we go. That's better. So what are we talking about here? We're keeping the same kind of structure, but we're selling week to week against 50, 60, 75 days out in time. Still looking for the delta of greater than 0.6, still looking for the delta ratio of greater than 1.8, Michael, and still looking for a debit to strike difference ratio of less than 1 in those cases. So some investors will set it up weekly, but what I still want is the number of right cycles. It's a column that you can have in here. There we go, right cycles. All right, so why are right cycles important? Because I want to make sure I'm collecting a premium. If I can write this 8 times between now and expiration, I want to make sure that this premium is going to pay for that, and it doesn't look like it does. And that's, yeah, it's not. We're not looking for a positive right cycle, but that's something I might want to consider with these positions. So to me, optimal, 180 or days more out in time, delta of maybe 0.6 to 0.8 to start out with. I don't want to go too deep with a delta in most cases. But again, if you wanted to go shorter term, you still want a good number of right cycles to try to pay for the cost of the leap. And this isn't really cutting. I'd probably need to be closer to at the money here, maybe 77.5 strike against an 81 strike here, or be closer to at the money with a sold call to get more premium. But the right cycles are important as well. So if I'm, yes, 210 days out in time, I'm probably writing 20 days, 21 days out in time if available. So I have 9 or 10 right cycles on the position. Okay. All right. So again, we might add this one in with our playlist there for the calendar calls. But remember, you can go to YouTube, find PowerOptions there, go to the playlist, and you'll see some other ideas there, Michael, on calendar spread criteria, calendar spread ideas, the importance of debit to strike difference ratio in calendar spreads. Also, management tips, diagonal criteria spreads, managing the sold call, rolling a deep in the money calendar, fixing a broken calendar spread, and converting a calendar to prepare a long call. So there's some other concepts for you there as well. This one, good candidates for a poor man's covered call, reviews the criteria as we kind of just did, but a little bit more in depth of what we like to look for. So you can review those, but we'll probably put this one in there as well, into the playlist, and again, into the other terms. All right, so Michael, thank you for that question. And that was our review there of the calendar spreads.